Good afternoon, ladies and gentlemen. It's a pleasure to be with you this afternoon. My name is Trevor Wilde. I am the CEO and one of the investment advisors here at Wild Wealth Management Group. Thank you, first and foremost, for all of you joining us on this webinar today. I will say that I miss seeing you face to face. We've had many clients for 15, 25 years where pre-pandemic, pre-COVID, this event was one of two events that we did every 6 months. We would do our forecast event in January, followed up by our halftime report, which we would do in every August. Obviously, with the pandemic and everything else, last year we converted all of these events to webinars or virtual events, and have made the decision to continue that through this year in hopes that we get back to doing things normal as we get to the back half of this year into 2022. I hope you and your families have been safe and healthy. I'm excited to share with you some thoughts tonight as we get into the halftime report for 2020. Before I get into the nuts and potatoes of everything that we're going to cover tonight, I do want to spend just a few minutes going through and introducing you to some of our staff. Now, many of you know some of these folks, but there might be some names and pictures and some people that maybe you've never met before, so we thought it'd be a nice opportunity for you to get a chance to see some of the people that might be behind the phones with the people you're talking with. Our leadership team, again, myself, I'm Trevor Wilde, the CEO of Wild Wealth Management Group. My dad and my father and co-founder of Wild Wealth Management Group, Bill Wilde, is one of our board of directors. Janine Lackey is our chief compliance officer and one of my partners, as well as Jackie Yoder, who is our chief operating officer and a partner of the firm as well. Now, many of you, you know your advisors that you're working with. That goes without saying, but we thought you'd put a picture to some names in case you're on webinars and maybe you've never had a chance to talk to any of the other advisors or meet any of the other advisors, to show you the full scope of the practice and of our business. Many of these people you'll hear, we do a rotating series every month with a different educational focus and a webinar. And you'll recognize some of these names, and I'll get to that in just a few minutes on some of the upcoming events that are happening the back half of 2021. I'm not going to read off each name, but you'll probably recognize the advisor that you work with and maybe some of the others that you've seen around the office or maybe on a webinar. These are the investment professionals that work out of our Scottsdale office. And for those of you who didn't know or don't know, we do have 6 offices in total. We have our primary office here in Scottsdale, and the previous slide showed the advisors that work out of that office. We have an office in Glendale that we opened back in 2008. With 2 full-time advisors that work there and a couple full-time support staff. We have an office in Tempe that houses 3 full-time advisors and 3 full-time support staff. An office in Tucson with an affiliate, an office in Payson, and recently we brought on a new partner in San Luis Obispo, and who is opening an office for us in San Luis Obispo. Moving forward onto our investment team of professionals that support us. Many of you spend a lot more time on the phone with some of these folks than you might with your advisor. We are blessed to have an amazing support staff that's spread across the valley in these different offices. Again, I'm not going to go through each of these names, but we thought we'd give you an opportunity to put a face to the name behind the people you're talking to as you're on the phone working through whatever it is that you're working with. Again, and I do want to say a special thank you to our staff. 2020 was a challenging year with the impact of COVID. 2021 continues to be that. We've got a lot of young kids within our family of support team, and I will just say that our team was phenomenal at getting through last year. Through working from home, coming back to the office, dealing with kids that were at school, then home from school, and as we head into the end of August here, and most of the schools around the state of Arizona are starting, we're hoping this becomes a little bit more of a consistent year, not only for our team, but for all of you as well. A few things that we are proud of that we just wanted to highlight. These are some achievements and some community outreach events that have occurred so far this year. So far in 2021, we were ranked by Barron's. Barron's does a top 1,200 advisors around the country. We've been blessed to be amongst that list for the last 13 consecutive years, and we're ranked number 2 in Barron's this past year. Forbes came out with what they call a best in state advisor. We ranked number 2 in that category. The Phoenix Business Journal ranked us as the 15th best places to work. We were the 15th ranked firm to work for our size of organization, and that I am really proud of. We worked really hard to provide a great place to work and a family environment and a friendly environment. I'm proud that we made that list. We continue to try to say thank you. We primarily have grown ultimately just by referral, and we have enjoyed doing something a little bit special for each of you every quarter, where we just provide a little token of appreciation in the form of a gift card for clients that refer somebody to the organization. I want to thank all of you who've referred to our firm and to the advisors you work with. We did have a tremendous year. We had more referrals in 2020 and 2021 than we ever have before, and that's because of you. So thank you for your continued support and trust, and we look forward to continue to help you meet your goals and dreams. We had a lot of new team members join the list. We brought on 4 or 5 new advisors around the state of Arizona and 1 in San Luis Obispo. We brought on some new staff. So I'm sure as we get through the back half of 2021, you will be seeing some unfamiliar names, and we hope you'd take a moment to welcome them to our organization, and look forward to having you get to know them a little bit better. So thank you. Upcoming webinars, we do have a list of events that are scheduled between now and the end of the year. And actually, before I get into the webinars, our charitable event, many of you know we created a charitable community outreach program that we called Wild for Arizona. Every quarter, as an organization, our team selects a charity that we support, and we solicit your help in supporting that charity. For Q3, which will go through the end of September, we've chosen an organization by the name of Free Arts, and we are doing a supply drive. If you're interested in participating, you can go to our website or just call our office, and we can give you information about how you can support that. And then Q4, as we've done for the last 17 years, we partner with Toys for Tots, and we'll be creating a toy drive into the fourth quarter. More information will come on that as well. Webinars and educational events. As I mentioned earlier, we do an educational forum that we rotate every month. We change up the education or essentially the topic, and our different advisors teach those educational series. So we do have a schedule between now and the end of the year. Our September schedule will be special needs planning. That's going to be hosted by Curtis Brutzman, one of our CFPs. October, the topic will be retirement challenges for women, and that will be hosted by Scott Aiken, one of our advisors in the Tempe office. November will be planning for long-term care, and that will be hosted by Seth Wilde, my brother. And in December, to wrap up the year, the topic will be retirement income planning. That will be hosted by Jeff Anthony in December. More information will come. We typically send out email invitations to those events. So just to highlight, if any of those topics ring a bell or something you might want to talk about or learn more about, please let us know. Feel free to call the office, and we'll pass that information along to you. 2021, some of the charitable events that I already mentioned. Free Arts is the Q3 focus that we're doing right now. Q1 we chose a program called the Brown Bag Program. We had a very successful food drive. Thank you to all of you who participated. And Q2 we chose a charity called the Southwest Human Development, which was a book, hygiene, and diaper drive. We raised over $2,000 in donations and was a very successful drive in the second quarter of this year. Again, I want to say thank you for your support because you guys make that possible. A couple other exciting things that we did this year that you may or may not have heard about. We created 2 scholarship opportunities. We've partnered with Cetera Advisors, and in partnership with ASU, we have launched a financial planning and diversity scholarship through ASU's financial planning department. And that starts actually this spring. We actually have our first award recipient who will be taking and accepting that scholarship going into this fall, and we're super excited about that. And we also partnered with Arizona Tuition Connection and Notre Dame High School, and have created and donated $25,000 to a scholarship to help support low-income students who might want to attend Notre Dame High School. So those are exciting things. If you know somebody you think could benefit from that, please let us know, and we'll put you in contact on how they might be able to look up that scholarship and maybe take advantage of it. We have a number of affiliates in our different offices. Again, I'm not going to go through this in detail, but we are really proud of the organization that we're building. We have some phenomenal professionals that work day in and day night to help their clients meet their goals and dreams, and we're super proud of that. Additionally, many of you know who have been a part of this organization, one of the things that we've done differently is we've brought partners in that specialize in different parts of the business, different than what we do. They don't do investment management. or financial planning. They do estate planning, tax planning, property and casualty insurance, life and health insurance. And here's a few of those folks on the screen here that specialize in those different areas and are very important to us as we help you meet your goals. So as we turn the corner to the meat and potatoes of tonight's conversation, as we usually do, there's 3 topics of conversation that we're going to go through tonight: where we've been, where we are now, and where we think we're headed. And we try to keep this relatively simple. We're going to focus on the where we've been, which is going to be the first half of the year, January through the end of June. Just as a side note, we actually start to put this presentation together at the beginning part of July. So all the data and the slides that you're going to see here primarily are going to be from June 30th of 2021 and back. And there's always a lot that changes, right? It's been almost 45 days since we put this together. And we'll talk on some of those things because already some of these statistics and slides have already changed a bit as we got into it. So we like to create a title or a theme for each one of these events, whether it's the forecast event or the halftime report. Our theme for the halftime report this year is the reopening, right? And that can mean a lot of things to a lot of you, whether it was traveling to see family members that you weren't able to see last year, really for the last 2 years, or being able to travel, or getting back to work, or whatever it might mean to you. But we're going to kind of hit on some of those things as we looked at the first half of the year that were important as we got through that. And the first one is obviously the vaccines. You know, in looking back, the vaccine was probably the key to the reopening, or at least of what we've seen so far. Now, again, when we were putting these slides together a month and a half ago, the Delta variant really hadn't been talked about, and we've seen a spike in that. And now we're kind of back in, basically in being in concern around, okay, what does this mean to the reopening? Will it disrupt it? We'll talk a bit about that and what our hopes are as we get back to the, to the end of the year. Bending the curve. So this is a really interesting graph. If you can see it, it's color coded. The darker the blue, this really tracked and monitored vaccination rates, from January 1 through the middle part of the year. What you're going to find is that confirmed COVID cases peaked at about 250,000 a day in early January, and by the end of June, which was the frame that we were looking at here, by the end of June, those daily vaccination rates in the United States got to under 13,000. And let me go back. I said vaccination rates. These are confirmed COVID cases. So we hit a peak in the United States, about 250,000 a day, back in the beginning part of January. By the end of June, we were down to under 13,000, about 12,500 a day by the end of June. Obviously, with the Delta variant, we've seen some things spiking here in the last 45 days. But what's interesting is you look around the globe, and you can see that the chart there tracks the United States. But if you look at the graph, it looks at other parts of the country and vaccinations that have been administered. The darker the color, the higher population, the higher percentage of the population has been confirmed with at least 1 dose. So at the end of June, about 23.5% of the world's population had received at least 1 dose. Now, it might have been higher here in the state. Well, you can see those statistics are very skewed, because if you look at parts of South Africa and other parts of the country, in particular the low-income countries, those percentages at the end of June were less than 1%. And you can see that on that color coding, those areas of the globe that are coded either white or really light blue had very little vaccination. So what we're seeing here is that the United States does tend to be ahead of the rest of the globe, right? Where we saw very little and still are seeing very little in other parts of the country or other parts of the globe. This is something we're going to have to continue to monitor. It was interesting, though, as they even rolled out the vaccinations here in the United States. And it's interesting because, man, does 5 months make a difference? But you have to think back to January and February, where I can tell you out of 2 or 3 calls that I might take a day from clients, the vast majority of people are trying to figure out how they could get in line to get a vaccine if they decided they were going to get it. And we saw a lot of incentives. Ohio offered a Vax a Million drawing, free donuts from Dunkin' Donuts. There was sweepstakes for grocery cards, the Daytona 500 to Super Bowl tickets, free MLB tickets, shopping discounts. Companies were offering paid time off, all in an effort to try to incentivize people to get the vaccinations. And what we saw along with that, as we looked at the global stock markets, is we saw equities rise. And what you'll see on this chart is year-to-date performance. Again, this is all through the end of June for the major markets around the world. And what you'll find, not unlike the vaccination rates, is the U.S. markets were ahead of the curve with performance, 14.1% for the United States. The world index was up 12.2, Europe up 10, UK up 10.4, and you can see it. What's interesting is you look at right at the middle of that graph, China and the Far East were very, very low as far as performance with their markets. Again, something we're going to have to continue to monitor. Also interesting when you go back to that vaccination chart, where vaccinations were least. If we break it down and look a little bit deeper into the general market, what we saw, and really this goes back to late October of last year, which we call Vaccination Day Rally. So again, the previous chart showed January 1 through June 30th of this year. But if we take a step farther back, we actually go back to last November 9th is when the vaccinations got approved. And really what we saw was a rally that started. And it was interesting because if you go back to last November, the election wasn't completed yet. A lot of things were happening or just had been completed, still a lot of uncertainty. But as soon as the vaccination was approved, and you can see on the screen here what different asset categories, how they performed since November 9th, it's been a very strong market. We always like to quote different people, and in particular the larger media publications. But here's an interesting one that we found, and I'm not going to read all these as we go through this, but this is was interesting from the Financial Times. Now this was June of 2021, so just about a month and a half ago. More than a dozen of the roughly 40 companies in the S&P 500 index that suspended their dividend last year had resumed paying it by the end of May. Many dividend-paying companies fall within the cyclical bucket of stocks that are expected to be among the largest beneficiaries of the economic recovery. Again, what a difference a year makes, even 6 months. A year ago, June, we were living in complete chaos and uncertainty regarding the economic system, where COVID was going, when would vaccinations be out, and what would the impact be. It's pretty amazing that when you take a step back and think about the severity of what we went through last year, how quickly the economy and the financial markets recovered. We're going to talk more about that, what we might expect to see. Earnings have been robust. So for the first half of the year, earnings recovery in the first quarter grew at 52.9%. Only 23.7% growth was expected at the beginning of the year. So again, when you think about, okay, well, the first quarter growth was 52.9% year over year for the first quarter. And people say, yeah, but expectations have been dialed down. But even updated expectations going into the year, only 23.7% growth was expected. What we saw was 53% growth in the first quarter. And this is an amazing statistics, but 86% of companies that reported actual earnings above estimates. Typically, a good reporting year, we would see 50 to 60% of companies beating earnings. We saw 86% of the companies so far that had reported, again, back to the beginning of July, had beat earnings estimates. These are really phenomenal increases. So some of these slides are going to get pretty technical. I know a lot of you on this webinar might be technicians and might enjoy this. Some of you, this might just be a little bit too much. But the Shiller PE ratio, which is one that we always kind of like to have a chart or two on, it does get a little bit technical, but the general idea here is trying to maintain value in where things are, and in particular how earnings and price earnings ratios are adjusted to inflation on the previous, kind of on a rolling basis. And what we can see here is there were spikes that go back to 2000, but earnings on an inflationary basis, the United States still valuations rose sharply. And if you look at kind of from a rating perspective, the United States has a higher ratio than most of these other countries that you can see on here. And it brings up a point that some have been paying attention to. The last couple of years, even before COVID, the international markets have lagged the United States in performance. Now with COVID, that divide has even become larger, and that's represented here on the Shiller ratios. This is one of the things that we're looking at, monitoring our investment team, is when is the right time to start to get more exposure into international markets. We don't know that we're there yet. Our tendency would to continue to have a bias towards the United States, but as the United States market continues to climb, there does seem to be more value that's presenting itself internationally. Again, something else we're going to have to monitor. Total fiscal stimulus, and again, this is a big point of conversation no matter where you go, but prior to June, prior to the end of last year, up from that point, the total amount of fiscal stimulus that had been provided to the economy was $5.3 trillion. Now, when we put this slide together, the American Jobs Plan proposal and the American Family proposal were just proposals. About a week ago, we just saw the passage of an infrastructure spending bill that's going to add nearly about another $1.5 trillion to this 5.3. This is historic, and we're not going to go into this in a lot of detail, but it's always interesting when you go back and look at previous years, previous periods of time where the government did stimulus, 2008, 2009. The amount of stimulus that we saw in 2008 and 2009 through that last financial recession was a lot of money. But what happened is it was monitored and done very slowly, QE 1, 2, 3, 4, and essentially they did it over about a year and a half, almost a 2-year period. It wasn't even a fraction of what we're seeing this go around. The other thing that was interesting is how the focus on this stimulus proposals or what's happened so far has really been direct to public. And what we have here on the slide is a picture of the United States of America, color coded to those states that received the most amount of funding. The lighter the color, the least amount of per populace funding. The darker, the more. You can kind of get a gauge of where the majority of the money went around the country. This is something else we're going to have to continue to monitor. What's interesting is with all the uncertainty, some investors did embrace speculation. And what we have up here is a chart of IPOs and meme stocks. That meme didn't mean anything a year ago. Now it's got a whole title of its own, the meme, the Reddit stocks. And what you can see as you look to the far right of that graph, at the early part of last year, 2020, and already this year, we've seen a spike in IPOs under what's called SPACs. And we're not going to get into trying to educate you on what a SPAC is. Essentially, SPAC, though, is a method of going public, and it's been around for many, many years, but it became more popular to be used last year and this year. So it's interesting because you think of all the things that are happening and the uncertainties that exist. We actually saw an increase in IPOs and what we would call speculative trading. Another interesting area is the green stocks. In other words, stocks that might be more environmentally friendly. Prior to 2020, there was few and far between. What we're seeing here over the last year and a half is green is no longer becoming a subset of its own. More and more traditional funds are starting to integrate more green strategies into there, and we're certainly seeing a lot more investment options, even as an investment advisor, available to us that have track records and have solid management teams. Something else we're going to have to continue to watch. So the Treasury market, which is the government bond market, doesn't necessarily show us that they're not worried about uncertainty. And what you can see in this slide from left to right is the Treasury yields as it happened over the last year. We saw a spike or a drop in Treasury yields as we got to the beginning part of this year, which generally would suggest that we're going to see soft economic times. The government's going to keep interest rates low to try to continue to influence money and to put it out into the economy. We saw a spike in the second quarter of this year from about February through the end of April, where essentially we started to watch this, and the Treasury market was saying, hey, things are getting better. What we saw in the last couple months of the second quarter and into the beginning part of the third quarter is that Treasury rate actually came down. And what that might indicate is that the Treasury market is not so sure that we're not out of the woods, so to speak, and interest rates came down, which reflects the fact that, again, we might not be in such stable ground as they thought before. And I don't need to tell you this, if any of you have owned a home or if you turn on the TV, everybody's talking about the residential housing market. Home sales went through the roof. 5.8 million homes sold. Existing home sales are up 44.6%. Now, this is national average, not Arizona or any other part. National average, $350,000 is the median sales price, and that's an increase of 23.6% year over year. We're going to talk a bit about interest rates, but we're not going to really talk about mortgage rates, but I do find that it's one of the biggest factors, I believe, as it pertains to housing values is interest rates, right? And if we go back to see where 30-year fixed mortgage rates were pre-pandemic, 30-year fixed mortgage rates in the beginning part of 2020 pre-pandemic were floating somewhere around 4.5% plus or minus. And if you haven't looked, you need to go look at your statement and find out what the interest is that you're paying, because current mortgage rates are floating somewhere between 3 or under. And they got as low as 2.5% the early part of the year. So when you think about what does that really mean? Well, if interest rates go from 4.5% to 3%, that drop in interest rate means that the same borrower, income the same, can afford 25% more home. So we're seeing that reflected not only in home values, but in the price of homes that are being sold. There were 5 cities, though, that saw significant population declines. And as you might have guessed, they represent really the metropolitan hubs of many of these cities. New York City, Los Angeles, San Jose, Philadelphia, and Chicago were the top 5 cities that saw population declines. And a lot of that population, really expanded out into the suburbs and to other areas. Another quote, and I'm not going to read the whole thing, but ultimately what we've seen is rents declining in markets like Manhattan and New York City. These were areas that people never thought rents could decline, but the pandemic shut those cities down so dramatically that we've seen significant rent reductions as we've gotten through this. Again, another point that we're going to have to monitor and watch to see how we go as we get out of this recession. All right, so we've talked about where we've been so far this year from January through the first half of the year, a little bit about last year. What we want to do is kind of pivot and look at some of the economic data points that we're looking at right now, and then we'll transition at the end here and talk a little bit about what some of the things that we're going to be watching as we get into the back half this year and beyond. So where we are now, and this was again just a nice quote that we found in Barron's, and this is a topic that we're hearing everybody start to talk about and worry about. Inflation is still increasing, economic earnings growth are accelerating, and monetary and fiscal policy remains very, very supportive. That's a combination that's been seen during just 10 quarters over the last 60 years. So the point in this quote is, and this is an area of inflation we're going to get into a little bit, but we've got a lot of forces that are emerging at once. We have an economy that's starting to restart coming out of the shutdown from last year. We have monetary and fiscal policy that still remains very, very positive. As I mentioned, we just saw another bill passed this past week on the infrastructure spending bill, and that's going to continue. Interest rates are low, inflation. The economy is still growing. Now this chart, again, there's two different, you have the gold bar and then the blue bar. The blue bar that, really if you go from left to right is a consistent, that's the actual dollars in gross domestic product or GDP that you see. The gold bar is quarter over quarter changes in GDP growth. Now, if you go back or just to the far right of it, what you're going to see is a dramatic sell-off. It's not a sell-off because this is GDP growth, but a dramatic decline, about this time last year in economic growth. And that was the shutdown. That was last March, April, May, as we went into full shutdown. Obviously, we accelerated up, as you can see to the far right. We had a little bit of pullback. Now we're seeing it accelerate. We're still getting economic numbers for the third quarter, and something else we're going to have to watch. Unemployment, another really, really big factor, and it is improving. What you can see on this graph is we hit that high, about 14.8% unemployment we reached last May. And we've seen a steady decline ever since then, but we're not down to pre-pandemic levels. The unemployment level prior to the pandemic, prior to March, was about 3.5%. As of the end of June 30th, we're sitting about 5.8% total unemployment. What's interesting is, so what that means is there's about 8 million Americans that are still collecting unemployment. Where the disconnect is, and if you've been around and talked to any employer, employers are having a hard time finding people to work. And you've seen it, we've seen it across the country. And the bottom line is we've got unemployment benefits that were mandated a year ago. We've got a federal and a state unemployment benefit. We've seen a handful of states that have started to pull that back this summer, but that federal unemployment continues through the end of September. Our expectation and what we're monitoring as we go into the fourth quarter this year, and what we're hoping for, is as that federal unemployment mandate goes away, a lot of these jobs will be filled. And hopefully we see that unemployment go back down closer to pre-pandemic levels, which again, we're at about 3.5% pre-pandemic. There's a lot on this slide, and there's a lot of theories as to what's going on with unemployment. We kind of talked about some of it, but there's a lot. There are those out there that still are concerned about the pandemic and what that means in going back to work. There are some out there that believe the unemployment benefits have just been too generous, and there's a lot of people that are just going to collect that benefit till it goes away. Wage competition among employers is going to be a challenge. And look, around the country, I mentioned this early on, many of our staff have young kids at home in elementary school and high school. I have them kind of across the board. We've got a couple in elementary school, we've got two in middle school, one in elementary school, two in middle school this year, and a sophomore in high school. And I can tell you it was challenging for a lot of families last year where the kids were going to school, coming home, and really where do they need to be? And there are many people that still feel that they need to be home, or at least that's the theory. There's a lot of people that might be reconsidering career options. I believe the pandemic for a lot of people was a little bit of a awakening. to what they wanted, how they wanted to live their lives, and that might be changing for some folks. Hiring challenges and skills gap. Now, these are all things that are impacting the theory of why unemployment is staying higher than we'd like to see it. We're going to have to continue to monitor these and see how things go in the back half of the year. Spending is up and savings is down. Now, this doesn't, that title I think sounds a little bit worse than it really is, because what we have seen over the course of the last 18 months is money in money supply. The government tracks what they call M2, which is money supply that's readily available to everybody out there. Your bank account, your savings account, your certificates of deposit, anything that you can readily convert to cash, not in retirement accounts, but in the bank account, was up dramatically year over year. And that might have been for a lot of different reasons. Number one, people weren't doing what they normally do. The vast majority of our clients are retired, and it wasn't uncommon for people to take 1, 2, 3 trips a year, and that didn't happen last year. People were stuck in their homes, so there was a lot of things that people weren't doing. But the other thing that did happen is that the vast majority of people were receiving direct stimulus payments that went into the bank, and other things, and refinancing that might have helped save money. So it's interesting because we've seen spending, and again, through this entire recession, though, spending has been relatively strong. This is, again, something we're going to have to continue to watch. I found this funny, they call it revenge spending. Last year you were locked up for the vast majority of the year. We had a holiday season in 2020 where, at least from talking to my clients, I know the vast majority of my clients didn't do what they normally do. They weren't able to travel across the country to see their family. Many of them didn't do any local gatherings. It was just a weird environment. It is one of our thesis, though, going into this year on why we are going to have a strong holiday season. You can call it revenge spending or whatever you want, but consumers here in the United States are really poised to spend well. We're expecting that we're going to see a strong fourth quarter as we get into that. But it doesn't go without its challenges, right? And I know you've heard this topic of the supply chain bottleneck or shortages, and it doesn't matter if it's a refrigerator or a window. We're seeing that shortages of materials, higher commodity prices, transportation challenges. And then again, we already talked about the unemployment, but there's a lot of facilities that are having a hard time finding employees to come back. All of these items that are listed here on the slide are creating these things. And we are seeing higher prices in a lot of them. I'm going to give you a quick story. So, my kids were back in the backyard playing softball with each other. One of them hit the softball and cracked our back window. The good news is it's not completely shattered, so we were able to tape it up, and it's not really an emergency thing. But I have a friend that owns a door and window company. I said, hey, we need to order a window. He called me back and said, hey, we just priced out your window, and right now, because of these shortages, you're going to spend about 15% more on this window. It's going to be 5 months before we can have it. We ordered the window in May. Today it's August 17th. We still don't have it. We're hoping to have it by the end of the month. And I've heard stories from clients that have gone through the same thing, whether it's a refrigerator or a vehicle that they're trying to get. But these are real issues that could have an impact on spending, right? I mean, even if the slide before, if consumers are ready to spend, if you can't get the item, then it's not going to be there to spend. So this is a big thing that we're watching. The reality is, I think that it's going to take some time to get supply chain and some of these things back to a normal rate. And it's not going to happen overnight. Even if the federal unemployment goes away at the end of September and everybody goes back to work, again, that's not going to happen overnight. So we are going to see a prolonged period, in our opinion, of inflation and some challenges in some of these areas that could have an impact on the economy. And those are things that we're going to have to continue to monitor. Inflation is rising faster, and I'm going to add here, than some expected. And again, this is a high topic about what's really driving this inflation. Is it just demand? Is it supply chain? Our belief is there's probably a lot of factors that are going into it. Again, you can't forget that last April, March, April, May, these factories were pretty much shut down. China quit shipping stuff out of their area and importing. So we've got, maybe a 2 to 3 month lag where next to nothing happened. And then even then at the end of last summer, as employers were starting to bring people back and maybe getting people back to the production line, there was so much uncertainty. The business owners and operators that I know, very few of them were jumping right back to 100%. They were being monitored. They were being slow. They were being cautious. And those are going to create lags that are probably going to continue to see, or we're going to see inflation in some of these items. The important thing will be, can supply chain get back in quick enough to avoid this inflation that some are expecting, that some have seen are faster than expected? to get it back under control and in a moderate range over the next several years. This is yet to be told. And it's interesting, right? You got to go back a year to think about the toilet paper craze and how you couldn't get it. But inflation does have a physiological aspect, where you get consumers to start to worry about certain pricing going up, and maybe they do start to buy things that they don't necessarily need or buy more of, like we saw last year with toilet paper. And I think the biggest thing to learn here is perception can become reality, and we saw it last year. You couldn't find toilet paper in the grocery stores, and ultimately probably could have been avoided if people just calmed down. Inflation element of fear is a big one, and I'm not going to read this one, but this was issued in The Economist back on March 1st. Inflation is a real issue. We're going to have to continue to monitor it. And the Federal Reserve, obviously, one of their goals and the tool that they use to fight inflation is interest rates. Now, we haven't seen the Fed do anything with interest rates, and what they have continued to state is they believe that this inflationary component, that it's transitory, and we should see it start to subside. But we know at some point the Federal Reserve is going to have to raise interest rates, and we've got to be paying attention to that and how it might impact the different investments that we hold. And not just investments, but your home and even the debt that you carry. That's another thing that you want to make sure you look at. So these inflationary issues that we've seen have dampened consumer sentiment. We've charted it here on the chart for you all to see. If you look at consumer sentiment from last May through May of this year, consumer sentiment was up 14%. Economic conditions are up 8%. Consumer expectations are up 19%. But you can see if you change that period from April through May of 21st, where we see some more of that inflation, a lot of those figures turn south. And we've just got to continue to be monitoring this and watching how it impacts the consumer and how they spend their money. Bullishness, neutralness, this is an important thing to kind of continue to monitor. Others would call this investor sentiment. How good does the public feel about investing? On this chart, blue represents bullish investors, people that are saying, yeah, we think the markets are going to continue to improve. The gray, light blue is neutral. There are people essentially saying, hey, we're not sure if it's going to be better or worse. And gold you can see is bearish. And then we've got a date bar. What you can see is, bullishness has started to subside a bit as we've gotten through the first half of this year. And bearishness has increased a little bit. So again, another important thing, if investors lose confidence, that's a big impact on the markets. So we've talked a lot the last 15 or 20 minutes about the things that we're dealing with right now. And many of these are going to be items that we're going to continue to monitor as we get through the back half of the year. Inflation, is this transitory? Does it start to go down as supply chain gets back on? Unemployment, do we see unemployment numbers subside as some of these other mandates and other things kind of filter down? Vaccinations, we can't stop monitoring those because that does seem like a key that's important to economic progress. What we want to do is just turn the tables a little bit and talk about, again, more of the things that we're going to be monitoring in the fourth quarter of this year. And this last segment of the presentation, we always like to poll well-known economists about what they believe is going to happen or what they're forecasting for the back half of the year. But before we do that, this was just kind of a cute little slide that talked about autonomous cars. And generally, what they said is if every car on the road is autonomous, if every car is perfectly behaved, autonomous vehicles are rational and patient and good-natured in a way that human drivers are not. It means that pedestrians, cyclists, runners, little kids kicking a ball, playing soccer can do whatever they want. They can just take back the road. If every car on the road is autonomous, pedestrians aren't terrified anymore. The cars are perfect. I'm not so sure that I believe that all the way, but it is a futuristic way of thinking about things and maybe a little bit of forward-looking into what we might be heading into. Shifting away from that and getting back to the economy, the Conference Board, which is a nonpartisan think tank, estimated 2020 economic growth rates to be a best case and worst case scenario. The best case scenario was over 6% growth. The worst case scenario estimate was about 5.5% growth. But what they did here that was interesting was they talked about some of the things that they believe was important in dictating whether we see the best case scenario or the worst case scenario. But we think these are important things to monitor as we get into the back half of the year. The vaccinations, we've talked about that. New waves of the virus. Now, keep in mind, when we put this slide together back in the beginning of July, this Delta variant wasn't what it was today. So we're already seeing that. Vaccine ineffectiveness, do we see that? Fed tightening sooner than expected, unemployment deteriorations, consumption recovery, and stock market corrections. All factors that we'll have to continue to monitor and could have an impact on the growth or how things go in 2021. The best case back in April from the conference board was a 7.4% growth rate. Again, outlining some of the things that they saw. New cases of COVID fall dramatically from May to June. Social distancing standards were eliminated or dramatically reduced. Vaccines become readily available. And the new administrations at the time, what they said, the infrastructure spending plan, which was, we weren't sure, which again, as I mentioned earlier in the presentation, was passed about a week ago. Geopolitical risks still continue. China technology decoupling with the US, Chinese aggression towards Taiwan, crowding on the polar silk, major cyber attacks, vaccination building emerging countries. Now, again, keep in mind, we put this together back in July. Some of the events of the day that we're seeing right now is what's happening in Afghanistan. We've seen a earthquake in other parts of the world. We're seeing really horrible devastation at a time when this illness can probably really run rapid. So geopolitical risks, and for many of you that have attended this in person or have watched this webinar before, geopolitical risk always tends to be on the board for a disruptor for growth. And this is no different. The issues might be a little bit different, but we're going to have to continue to monitor these and keep an eye on. We talked about green, ESG, environmentally, socially responsible funds are echoed through earnings calls. So again, 2 years ago, we wouldn't hear companies that weren't involved in green energies talking about it. We are hearing it through earnings calls across the board, not only in clean energy, but diversity, equity, and inclusion. These are all factors that have come to light. And in many cases, not because of COVID or the pandemic, but a lot of the things that we've experienced as a country the last 18 months. And they are exciting to see, at least from my perspective. We didn't talk much about this yet. We talked about the stimulus the government's done, but growth can be affected by debt. The Office of Management and Budget at the Federal Reserve Bank of St. Louis created this chart for us here that we're sharing with you. But as we talked about earlier, the U.S. government spent more than $5 trillion in pandemic support to get us out of this. And there's more. As I mentioned, we didn't even know that the plan that was just passed for the infrastructure and spending bill wasn't even approved yet. The orange on this chart shows the total national federal debt. The blue area shows the debt as a percentage of GDP. At the end of the first quarter, the national debt was 127% of GDP. We can't ignore this. At some point, this could become an issue. Now, we spend a lot of time talking to clients about this because this tends to be one of those talking points that's often brought up. We're not concerned about debt in a short-term perspective of the next 6 months or 12 months. Debt, though, at these levels can be economically challenging, in particular for the long run. So this is something we're going to have to monitor. Now, we've heard, and we're not talking about it in the presentation tonight or this afternoon, but we have talked, and you've heard of tax changes that are coming. We still don't know what those are going to look like. Many of you clients, is an area that we are going to have to continue to pay attention to. There's a lot of significant changes potentially in store: long-term capital gains, estate taxes, income tax rates. These are all things that we're going to have to monitor and may impact you. So this is going to be part of our planning focus on the back half this year. Hopefully we'll have more identified of what's going to change from a tax perspective. We can start to work with you and create a plan to help hopefully eliminate any negative things. This was just kind of fun one. Urban airports for drones and flying taxis. Again, futuristic thinking. And we're just coming out this slide talking about the national debt, and that's not very, very inspiring. It's not fun to see that debt grow so much. But there are some really innovative things happening and some really exciting things that I think we should be excited about. That might change the way we live, not only from transportation, whether we're talking about autonomous cars or flying taxis, but the improvements in healthcare and the technology that's happening in that area is just phenomenal. It's really unbelievable what is happening at the speed at which they're able to do things. And these advancements, and even things like this, the flying taxis may be approved in the United States as early as 2023 is what they say. So we'll have to continue to watch that. Data protection and privacy is going to be a continued issue. Unfortunately, there's more and more hackers and bad people out there that are trying to steal information with data security. And this is going to be something that we do think will be very important. We saw a number of hijackings, you could say, of large organizations that were held at ransom essentially for this kind of thing. And unfortunately, in the world we live in, we believe that's going to continue to happen. And this was interesting. Times Magazine reported that a skill-building robot for children, which encourages reading and drawing and spends them on a mission on missions meant to spur engagement with adults, siblings, and peers. This is the future that we are, the Jetsons of 2021. Who knows, perhaps employers will even start to develop their own version of these robots to help eliminate the skills gap that we talked about with unemployment. We're seeing this already around the country. Rapid charging electric car fueling stations, if you will, have become something that you do see more and more, especially in different parts of the country. But again, the reliance on fuel, again, another area that we're going to have to monitor and watch is how does this impact the economy? How does it impact consumers and where we're spending money? And how does this progress? So as I mentioned before, we like to always poll some industry professionals. So in this section, we're going to finish off with some of the kind of well-known industry professionals and what they're predicting for the back half of the year. Starting with McKinsey & Company. This was one of the partners of McKinsey & Company back in June. He said, we experienced the equivalent of 5 years of digital growth in 8 weeks of time. In that sense, we jumped from 2020 to 2025. This was amazing. The bar is much higher now for any business. They must compete digitally and on a global level, not just on a local one. It'd be interesting to see if commercial businesses take that approach and if they do it. The Economist in June of 2021, markets are forward-looking. They now have less to look forward to. If peak GDP growth lies in the past, the scope for further upward revisions to forecast for stock market earnings is limited. The S&P 500 index already trades at a high multiple of prospective earnings, and a lot of good news is already priced into risky assets. Lacking fresh influence to drive prices up, risky assets are vulnerable to decline. So it's clearly their take is that the market is susceptible to a downturn. We'll have to monitor that and see how that goes. BlackRock managing director back on June 2nd, in less than 1 year, the biggest risk to markets has flipped 180 degrees. Rather than worrying about collapsing growth, today most investors worry about too much. In the process, treasury bonds have morphed from an efficient and reliable hedge to a source of risk. I didn't touch on this earlier, but I do find it interesting for safe assets when you're looking at bonds or traditional safe assets, which is what he's talking about in treasury bonds. The real return, if you look at a 5 or 10-year treasury bond, the real return, which is the interest you're earning minus inflation, is negative right now. So you think about that. We've got to be very careful about having our money in what is otherwise or historically known as a safe asset category. Doesn't look all that safe right now. A completely counter approach than the previous quote. He clearly believes that you're going to see accelerated growth in equities and not in some safe assets. Wilmington Trust back in June on June 27th. Over the next 12 months, stocks gains will outpace those of bonds and other defensive assets, but are certainly less than what we saw over the past 12 months. Maybe something in the mid-single digits, but overall we see the economy recovering, continuing, and being a tailwind for stocks. Again, a little bit of an in-between here. She's saying that she believes that the equity markets are going to continue to outpace other forms of investing, just not at the same pace that we've seen the last couple of years. That's probably not a fair, probably a fair estimation, given how strong the equity markets were last year. Lastly, Chief Economic Advisor for Allianz. This is one of the most well-known economists out there, in particular in the bond market. Every day I see evidence of inflation not being transitory. I have concerns that the Fed is falling behind and that it may have to play catch up. And history makes you very uncomfortable if you end up in a world in which the Fed has to play catch up. But again, the concern over interest rates and what he's saying there is that he believes interest rates are further ahead and maybe the Federal Reserve should start to act now. Here's what's interesting. The reason why we go through this exercise and take a few minutes to poll them, each and every one of these economists that we've noted are very well known. They're brilliant people with brilliant teams behind them. Yet we've seen differences of opinion ranging from the markets, which we're reading right here, are at high risk to the markets are going to continue to outpace. The point in which we're trying to make by showing you all this these different opinions is the reality is nobody's got a crystal ball. One of our objectives as your investment advisor, your financial planner, helping you with your life savings is to make sure that we're diversified, to make sure that we do have a percentage of your money in safe assets, so that if we go through a period of disruption like we had last year, we're not fully susceptible to the stock market, and then we do have a percentage of money in assets that can grow to meet your long-term goals and needs and keep up with inflation and these issues that we've talked about. We are dedicated more than ever to helping continue to do this. The market is ever changing, and we are committed to making sure we keep up with that. We continue to learn, continue to invest in our organization and people and in technologies to help us do that at the highest capacity. And we're proud to be your choice. In wrap up, again, we're here to serve you. I appreciate your time on the webinar today. I hope that this has been enjoyable. If you have comments or feedback, please let us know. Please feel free to call the office, contact your advisor that you work with directly. We'd love to have your feedback on how we can make this a better educational experience. As I mentioned at the very beginning, we look forward to seeing you again in person. And we are thankful for each and every one of you and the commitment that you've made to us and to our firm. And we promise you that we're working very hard to exceed your expectations and continue to fulfill your dreams and goals that you have and your families have. Thank you for your attention tonight. I wish you all a great summer, a remainder of your summer, healthy and happy, and we look forward to seeing you at future events as we get through the back half of 2021. Thank you very much and have a great day.